Imagine you're on a plane. The captain turns on the autopilot, leans back, and falls asleep. For the first hour, everything is fine. The plane flies straight, the altitude holds, the passengers feel safe. But while the captain sleeps, the wind shifts, the fuel gauge drops faster than expected, a storm forms on the horizon, and the autopilot, because it is a machine following old instructions, flies directly into it. That is what is happening to your money right now. You set up your finances months or maybe years ago. You automated your 401k, you turned on autopay for your bills, you picked a savings account and forgot about it. And you told yourself the most dangerous sentence in personal finance: I have got it handled. Today, Timmy Investor is going to show you why financial autopilot is not a strategy. It is a slow leak. And by the end of this video, you will know exactly where your money is bleeding, how much it is costing you, and the precise system to fix it without babysitting every dollar. Now, you might be thinking, wait, every financial expert says to automate, set it and forget it, pay yourself first. And they are right, partially. Automation is one of the best tools ever invented for building wealth, but there's a critical difference between automating a system and abandoning a system, and most people, without realizing it, crossed that line a long time ago. If you want to stop the quiet drain and actually keep the money you were working so hard to earn, subscribe to the channel. It's the best return on investment you will get on your time today. Let's start with the myth that got us here. The idea of set it and forget it became the golden rule of personal finance sometime around 2010. Every blog, every podcast, every YouTube channel repeated it. Automate your savings, automate your investments, automate your bills, and then do not touch anything. The logic was sound. Humans are emotional. We panic sell, we impulse buy, we forget to transfer money. Automation removes the human error. And for the first phase of your financial journey, this is genuinely brilliant advice. The problem is what happens in year 2 and year 3, in year 7. The automation keeps running, but your life changes, your income changes, your expenses change, the market changes, inflation changes, your bank changes its fee structure, your credit card changes its rewards program, your insurance company quietly raises your premium by 8%, and because you're on autopilot, you don't notice any of it. You are the sleeping captain. The plane is still flying, but it is no longer going where you think it is going. Let me show you the real numbers. I've spent a lot of time studying the exposed underbelly of automated finances, and the average American is losing between $3,000 and $12,000 per year to what I call autopilot decay. That's money that silently leaks out through forgotten subscriptions, suboptimal interest rates, outdated investment allocations, insurance premium creep, and fee increases you never approved but also never challenged. $3,000 a year might not sound catastrophic, but invested at 10% over 30 years, that's $540,000. $12,000 a year at the same rate is $2.1 million. You are not losing pocket change. You are losing a retirement. And the cruelest part is that you feel financially responsible the entire time because you automated everything. You did the right thing. You just never did it again. This brings us to the first and most common autopilot leak, and it is sitting in your bank account right now. I call it the silent rate collapse. When was the last time you checked the interest rate on your savings account? If you opened it more than 2 years ago, there is an extremely high chance you were earning a fraction of what is available today. Here's how it works. Banks attract new customers with competitive rates, maybe 4.5%, maybe 5%. It looks great on the marketing page. You sign up, you deposit your money, and you feel smart. But banks count on one thing: your inertia. 6 months later, they quietly drop your rate to 3.8%, then 3.2%, then 2.5%.
They do not send you a push notification that says, "Hey, we just cut your earnings by 40%. They bury it in a policy update email that goes straight to your spam folder. Meanwhile, new banks are offering 5% to attract fresh customers. You're sitting in the old account earning half that. On $30,000 in savings, the difference between 2.5% and 5% is $750 a year. That is $750 you lost by doing absolutely nothing wrong except not checking. And this is just one account. Multiply this across your checking account, your savings, your money market, your certificates of deposit, and the bleed accelerates. The fix is what I call the rate audit. Once every 6 months, spend 20 minutes checking your current rates against the top 5 options on Bankrate or NerdWallet. If the gap is more than 0.5%, move your money. It takes 15 minutes to open a new high-yield savings account. That 15 minutes could be worth $750 a year for the next decade. That's an hourly rate of $3,000 per hour. No job on earth pays that well for that little effort. But the savings account is just the appetizer. The main course is your investment portfolio, and this is where Autopilot decay turns from a leak into a flood. Let us talk about what I call the ghost allocation. When you first set up your 401k or your IRA, you picked an allocation. Maybe it was 90% stocks and 10% bonds. Maybe you chose a target date fund. Maybe your HR department defaulted you into something and you never changed it. That was fine for the person you were when you set it up, but here's the question. Are you the same person today? If you set up your 401k at 25 and you're now 38, your risk tolerance, your income, your timeline, and your life circumstances have fundamentally shifted, but your portfolio does not know that. It is still running the program from 2015. And even if your life has not changed, the market has changed. If you started with 90% stocks and 10% bonds, and the market went up 40% over 3 years, while bonds stayed flat, your actual allocation might now be 94% stocks and 6% bonds. You are taking significantly more risk than you signed up for, and you don't even know it. This is called portfolio drift, and the data on it is unsettling. Vanguard research shows that a portfolio that drifts without rebalancing can experience 20 to 30% more volatility than intended. In a downturn, that extra volatility could cost you $50,000 to $100,000 or more, depending on your portfolio size, all because you followed the advice to set it and forget it. But it gets worse. It's not just about allocation, it's about the funds themselves. Let me show you a specific example. Say you were auto-enrolled into your company 401k in 2018. The plan offered a large-cap growth fund with an expense ratio of 0.85%. At the time, it seemed fine, but since then, your company might have added lower-cost index funds at 0.03%. Nobody told you. Nobody sent you a notification. The new fund is just sitting there in the menu, waiting for you to find it. That difference of 0.82% doesn't sound like much, but on a $200,000 portfolio over 20 years, that 0.82% cost you approximately $96,000 in lost growth. I want you to hear that number again.
$96,000. Not because you made a bad investment, not because the market crashed, but because you never logged in and looked at the menu. The Autopilot kept buying the expensive option while the cheap option sat right next to it, untouched. The fix is what I call the annual portfolio physical. Just like you get an annual physical for your body, your portfolio needs one too. Once a year, log in and check 3 things. Number 1, is your allocation still aligned with your age and risk tolerance? Number 2, are there lower-cost fund options available that you were not aware of? Number 3, has your contribution rate kept pace with your income growth? That third one is a killer. Most people set their 401k contribution at 6% when they started their job and never touched it. If you got a raise from $70,000 to $90,000 and your contribution stayed at 6%, you are contributing $5,400 now instead of $4,200 in absolute terms.
That sounds like progress, but your savings rate relative to income is the same. You should have bumped it to 8 or 10%. That's $1,800 to $3,600 extra dollars per year flowing into compound interest. Over 25 years, that bump alone could be worth $200,000 to $400,000. Now let us talk about the autopilot leak that people are most embarrassed to admit. I call it the subscription graveyard. You know exactly what I'm talking about. That streaming service you signed up for to watch one show, that fitness app you used for 2 weeks in January, that meal kit delivery that still charges you $64 a month even though you've been ordering pizza every Friday. A 2024 study by C+R Research found that the average American spends $219 per month on subscriptions, but estimates they only spend $86. That's a perception gap of $133 per month, $1,600 per year that people literally do not know they are spending. And this is not because they're careless, it's because subscriptions are specifically engineered to exploit autopilot behavior. The business model depends on it. Companies like Netflix, Spotify, and Adobe know that once you set up autopay, the psychological barrier to canceling is far higher than the barrier to signing up. Signing up takes one click and a free trial. Canceling requires you to log in, find the settings page, navigate through 3 screens designed to make you feel guilty, and then confirm twice. They call it the friction asymmetry. Getting in is frictionless, getting out is an obstacle course. And because each individual charge is small, $9.99 here, $14.99 there, it never triggers your pain threshold. You never feel the cut. But 12 cuts of $15 is $180 a month, and that's $2,160 a year. And that, invested over 25 years at 10%, is over $236,000. The fix is the subscription purge, not an audit, a purge. Cancel everything, every single subscription. Then, over the next 30 days, resubscribe only to the ones you actively miss. You'll find that out of 12 subscriptions, you actually miss 3 or 4. The rest were phantom charges for phantom services. You were paying for the idea of using them, not for actually using them. Here's where the autopilot trap gets truly insidious. Everything I've talked about so far, the savings rates, the portfolio drift, the subscriptions, those are leaks you can see if you look. But there's a category of autopilot decay that is almost completely invisible. I call these the silent repricing events. Your car insurance premium went up 12% at renewal. It was on autopay, so you never noticed. Your cell phone plan got restructured. You are now paying $15 more for the same data. Your electricity provider switched you from a fixed rate to a variable rate when your contract expired. Your health insurance deductible increased by $500 during open enrollment, but you auto-renewed the same plan without checking alternatives. Each one of these is a company betting on your autopilot. They are repricing your life, and you are automatically approving it every single month. Let me quantify this. Insurance premium creep alone averages 6 to 10% per year if you never shop around. On a combined auto, home, and health insurance bill of $12,000 per year, that is $720 to $1,200 of annual increase that you never questioned. Over 10 years, that compounds to $12,000 to $18,000 in overpayment. A 30-minute phone call to compare rates can save $300 to $600 per year instantly. But because it is on autopay, because the captain is asleep, nobody makes the call. Let me put all of this together and show you the total cost of the autopilot trap. I'm going to run the numbers on a typical American household. We'll call them the Johnsons. Combined income $120,000. They did everything right 5 years ago. They automated their savings, their investments, their bills, and then they stopped paying attention. Here's what 5 years of autopilot decay looks like. Savings account rate collapse from 4.5% to 2.1% on $40,000 savings. Cost over 5 years, $4,800. portfolio drift plus high-fee funds in 401k on $180,000 balance. Cost over 5 years, $14,200 in excess fees and suboptimal allocation. Subscription graveyard, $133 per month in forgotten subscriptions. Cost over 5 years, $7,980. Insurance premium creep, never shopped auto or home insurance. Cost over 5 years, $5,400. Cell phone and utility repricing. Cost over 5 years, $3,600. 401k contribution rate stagnation, stayed at 6% through 2 raises. Opportunity cost over 5 years, $11,500. Total 5-year cost of Autopilot, $47,480. That is $9,496 per year, almost $800 per month. The Johnsons effectively have a phantom bill of $800 per month that they never see, never approved, and never questioned. And remember, this is a household that did everything right. They automated, they were responsible, they just forgot the second half of the equation. Now I want to show you the alternative, because the answer is not to abandon automation. Automation is still the engine. The answer is to add a cockpit check, a recurring, scheduled, systematic review that catches the leaks before they become floods. I call this the Quarterly Cockpit Protocol. It takes 90 minutes 4 times a year. That is 6 hours total per year. And based on the numbers we just ran, those 6 hours save the Johnsons $9,500 annually. That is an effective hourly rate of $1,583 per hour. There is no side hustle on earth that pays that. Here is exactly how the Quarterly Cockpit Protocol works. Quarter 1, January. This is the big annual review. Check all savings and checking account interest rates against current market leaders. Review your full investment allocation in every account, 401k, IRA, taxable brokerage. Compare fund expense ratios to alternatives. Adjust 401k contribution rate if you received a raise. Review insurance policies, auto, home, health, life. Get at least 2 competing quotes. This quarter takes about 2 hours. The rest takes 60 to 90 minutes each. Quarter 2, April. Run the subscription purge. Pull your last 3 months of bank and credit card statements. Highlight every recurring charge. Cancel anything you have not actively used in 30 days. Check your credit card rewards program. Is the structure changed?
Are you still optimizing? Review any auto-renewing annual subscriptions coming up in the next quarter. Quarter 3, July. Mid-year portfolio check. Has your allocation drifted more than 5% from your target? If yes, rebalance. Review your emergency fund. Is it still at the right level for your current expenses? Check your tax withholding. Are you on track for a massive refund or a surprise bill? Neither is optimal. Review your cell phone, internet, and utility plans. Call and negotiate or switch. Quarter 4, October. Pre-open enrollment review. Health insurance is the biggest one. Compare every plan option, not just the one you had last year. Review your flexible spending account or health savings account contributions. Check your beneficiaries on all accounts. People forget this after major life events. Set your financial goals for the next year and adjust your automation accordingly. That is it. 4 sessions, 6 hours per year. And the difference between the person who does this and the person who does not is, over a 20-year career, conservatively, $200,000 to $400,000. At the high end, it is over $1 million. Now, I know what some of you are thinking. Timmy, this sounds like a lot of work. I automated specifically so I would not have to think about money. And I understand that impulse. But here is the reframe. You're not choosing between thinking about money and not thinking about money. You're choosing between thinking about money for 90 minutes per quarter, on your terms, proactively, calmly, with a checklist,
Or thinking about money in a panic at 2 a.m. when you realized your insurance lapsed, your portfolio crashed harder than it should have, and you've been paying for a gym membership at a gym that literally closed 8 months ago. Proactive beats reactive every single time. And the 90-minute session is not stressful. It is empowering because every time you complete it, you find money. You feel like you just gave yourself a raise. It is the financial equivalent of cleaning out your closet and finding a $100 bill in every pocket. There is one more layer to the autopilot trap that I need to address, and it is the most psychologically dangerous one. I call it the competence illusion. When you automate your finances, you feel competent. You feel like you have your financial life together, and that feeling is addictive. It's comfortable. It's a warm blanket. But the feeling of being in control and actually being in control are two completely different things. The Johnsons felt in control. They had automation. They had a system. They had the warm blanket, and they were losing $800 a month. The competence illusion is dangerous because it prevents you from seeking improvement. If you feel like everything is fine, you do not look under the hood. And if you do not look under the hood, you cannot see the leaks. The antidote to the competence illusion is scheduled skepticism. 4 times a year, you deliberately question every assumption. Is my savings rate still adequate? Is my allocation still correct? Am I paying for things I do not use? Am I overpaying for things I do use? This is not paranoia. This is maintenance. Your car needs an oil change every 5,000 miles, not because it is broken, but because neglecting maintenance is what causes it to break. Let me leave you with a visual that I want you to carry with you. Imagine 2 bathtubs filling with water. The water flowing in is your income. Both bathtubs have the faucet on full blast.
But one bathtub has a tight seal. The other has 6 small cracks in the bottom. Each crack is tiny. You cannot see any individual one from across the room, but together, those 6 cracks drain the tub almost as fast as the faucet fills it. The person with the cracked tub works just as hard as the person with the sealed tub. They earn the same money, they automate the same way, but one ends up with a full tub, and the other keeps wondering why the water level never rises. The autopilot trap is not one big hole, it is 6 invisible cracks, and the only way to find them is to get on your knees and look. So here's the summary. Automation is the engine of wealth building, but without regular maintenance, it becomes the engine of wealth destruction. The average household loses $3,000 to $12,000 per year to autopilot decay across 6 categories: savings rate collapse, portfolio drift, and fee drag, subscription graveyard, insurance and utility repricing, contribution stagnation, in the competence illusion that prevents you from noticing any of it. The fix is the Quarterly Cockpit Protocol, 90 minutes, 4 times per year, 6 hours that are worth more per hour than any job you will ever have. Do not abandon automation, just stop sleeping in the cockpit. I want to hear from you in the comments. When was the last time you actually logged into your 401k and checked your allocation? When was the last time you reviewed every subscription on your credit card statement? Drop the honest answer below. I read as many comments as I can, and I think the answers are going to surprise a lot of people, including you. If this breakdown opened your eyes to a leak you did not know you had, hit the like button so the algorithm shows it to someone who is losing money in their sleep right now. Thanks for watching, and I will see you in the next one.